Hello, welcome back to another video. And in this lesson, we're going to be talking about stocks, bonds, and cash. So in last lesson, we introduced financial markets and talked about how they move money between people, businesses, and governments. But what are people actually buying and selling in these markets? Three of the most basic financial assets are cash, bonds, and stocks. You probably have heard of all these theories before some time, but they work in very different ways. Cash is money you can use right away. You have cash on hand? Use it. Easy as that. A bond is money that you lend to someone else, as we talked in our last video. And a stock represents ownership in a company when you buy shares of a company, of a public company. In this lesson, we're going to look at what each one of these means, why people use them, and how their risks are different. Let's go ahead and next. So, what is a financial asset? Before quickly explaining what a financial asset is something that has value and can be owned or exchanged. Cash is a financial asset because it has a value and can be used to purchase things. A bond is a financial asset because it represents money that you owe and that someone owes you. And a stock is a financial asset because it represents ownership in a company. These assets are not interchangeable, however. Each one has a different purpose, a different level of risk, and a different potential return. Let's begin with the simplest one, which is cash. Cash is money that you can spend or access quickly. This includes physical money in your wallet, money in a checking account, and often money in your savings account or just money you have in a bank. The main advantage of cash is something called liquidity. Liquidity basically means how quickly and easily something can be turned into spendable money. Cash is already spendable, so it is considered extremely liquid. You don't have to find a buyer or wait for a trade to happen. You just have cash right here. You can use it right away, right? It's as easy as that. And cash is also fairly stable. If you have $100 today, you will probably still have $100 tomorrow. That makes cash useful for everyday purchases, bills, emergencies, anything you expect to pay for soon, going to the store, or just whatever you might need to spend at the moment. However, cash does have several important weaknesses. The biggest problem with cash is inflation. Inflation happens when general prices of goods and services rise over time. The amount of money you may stay exactly the same, but the amount of money you can buy with that money actually decreases. So $100 now might be worth $90 in 10 years. Imagine that you put $1,000 on your bed and leave it there for 10 years, as I just said. After 10 years, you would still have $1,000. You did not technically lose any money, but food, clothing, housing, and other products may cost more than it did before, which means technically the value of your money, the value of your $1,000, technically depreciated over time. That means your $1,000 would have less purchasing hours. So that same amount of money would be able to only buy so many things. It would be fewer things you could buy with that same amount of money because the rise of prices of goods and services increased. While the value of your money, the amount of money you have, didn't change. $1,000 is still $1,000, right? Easy as that. That is why cash is useful for short-term needs. But people often invest some of the money when they're saving for much and longer periods. One possible investment is something called a bond. A bond is basically a loan that an investor makes to a company or government. Let's say a company, like I said in the last video, wants to build a store. And it wants to build a store, develop new products, it wants to expand. One way it can do it is by borrowing money and by issuing bonds to do that. Investors give the company money by purchasing these bonds. In return, the company normally promises to pay the investors interest. Governments issue bonds for similar reasons. They may use the money to fund roads, schools, public services, or other projects. The important thing is to remember that when you buy a bond, you do not own part of a company or government. You're basically a lender. You're given the money today with the expectation that they will pay you back later. And bonds are usually more steadier than stocks. The reason is because they are less risky, but that does not mean they are completely safe. One reason bonds are often viewed as safer is that bondholders have a stronger claim on a company's money than the shareholders do. If a company is struggling financially, it is still expected to make its required bond payments. So regardless of how the government's doing, they still have to pay those bonds. If the company fails completely, bondholders are also paid before shareholders receive anything. So bonds can often offer more predictable payments because investors often know how much interest they're supposed to receive. However, though, there are obviously still risks. A company or government could fail to repay the bond. It could fail to pay the debt that you gave it. Bond prices can also fall when interest rates change, when the Fed changes interest rates, which affect government bonds. We'll discuss that in more detail later in the course, but just know that interest rates do play a big role in bond prices. For now, the main idea is that bonds usually provide more stability than stocks, but they can still lose value. And now that we're talking about stocks, let's go ahead and talk about stocks. A stock represents an ownership in a company. When you purchase one share of a stock, you become a partial owner of that company. Your ownership might be extremely small, especially if the company has millions and usually billions of shares, but you still own a piece of that business. That is different from owning a bond, right? With a bond, you're lending money to the company. But with a stock, you actually own part of it. As an owner, you can benefit if the company grows and becomes more valuable. For example, imagine you buy shares in a company that later creates a very, very successful product. It could be anything. The company may earn more money, attract more customers, and expand its operations, cut back costs, and 1,000 other things it can do to make more revenue. As the business becomes more valuable, investors will be willing to pay more for its shares. That could cause the stock price to rise. On to the next slide. Stocks generally have more potential for long-term growth than cash or bonds. However, they also experience way more larger price movement. A stock's price can rise when a company performs well, earns more money, or is expected to grow in the future. And it can also pay dividends, as I said earlier, which is just cutting up the profits, part of the profits, and giving it back to the people who own shares of that stock. However, companies are not required to pay dividends, and many growing companies choose not to, right? To keep the money for themselves and use it on whatever they want to use it for. However, stock prices can also fall. A company may lose revenue, lose customers, face stronger competition, release a bad product, or earn less money than the investors expected. Sometimes stock prices move because of changes in the overall economy, even when the company itself has not changed very much. So if the entire economy is not doing well, chances are the stock price is also not going to do well, the individual stock price. They offer greater potential returns, but in exchange, they offer greater uncertainty and way larger swings in value. Here is a simple way to compare all the three assets. Cash is money that you can use right now. Its main purpose is spending, emergencies, and short-term saving. A bond is a loan that you make to a company or government. Its main purpose is normally earning interest and creating a steadier income. A stock is the ownership of a company. Its main purpose is usually long-term growth, and its main risk is that company's value and stock price could fall. Now, let's talk about how investors actually use these. The right combination depends heavily on what the investor is trying to accomplish. Imagine someone is saving for a vacation that is happening next month. It would probably make sense to keep the money in cash, right? The person needs the money soon and can't afford it to have its value suddenly fall. Someone who wants to have a more stable income might hold some bonds. The interest payments from the bonds provide a more predictable source of income. Someone who's saving for retirement 30 years from now, 40, 50, however many years from now, might hold more stocks. Stocks can fall significantly over shorter periods, but generally speaking, long term, they have more value and more time for the market to recover, meaning much more long-term greater returns. This does not mean everyone should use the exact combination because, well, everyone has a different individual situation or whatever they want to be using the money for. When deciding on how much cash, how many bonds, or how many stocks to own, there are three basic questions to ask. What are you saving for investing for? When will you need the money? And how much uncertainty can you realistically handle? Some people become extremely uncomfortable when the value of an investment falls. That's fair, right? You don't want to lose money. No one really does, right? Others are more willing to accept larger price swings, so they're willing to accept that they have to lose money, a lot of money maybe, in exchange for greater potential growth in the future. So these three factors can definitely help you determine what exactly you want to invest in: stocks, cash, or bonds. So let's go ahead and talk about the big takeaway. Cash is money that you can spend or access immediately. It is stable and liquid, but it may lose purchasing value because of inflation. A bond is a loan that you can make to a government or company. It can provide interest and more predictable returns, but the borrower still may fail to repay you, even though it's rather uncommon. A stock is a small piece of ownership in a company. It can offer greater potential for long-term growth, but its price can rise and fall significantly. In the next lesson, we will look more closely into different types of these things, and that's basically it. I hope you enjoyed this lesson, and I hope you have a great day. Bye-bye.